Question 1. Which of the following describes the primary purpose of the Securities Investor Protection Corporation, SIPC? A. To protect customers against losses due to market fluctuations. B. To ensure all broker-dealers maintain adequate capital. C. To protect customers against losses resulting from broker-dealer failure. D. To regulate the issuance of new securities in the primary market. Answer: C. To protect customers against losses resulting from broker-dealer failure. The Securities Investor Protection Corporation, SIPC, protects customers of brokerage firms from losses of cash and securities held by the firm in the event the firm fails financially. SIPC coverage is limited to $500,000 per customer, with no more than $250,000 of that amount in cash. It is important to remember that SIPC does not protect against market risk, which is the risk that investments will lose value due to broad market movements. Think of SIPC as an insurance policy for your brokerage account if the firm goes out of business, not if your investments decline in value. Question 2. An individual who provides investment advice for a fee, but does not execute trades or take custody of client assets, would likely be registered as which of the following? A. A broker-dealer. B. An investment advisor. C. A registered representative. D. An associated person. Answer: B. An investment advisor. An investment advisor, IA, is generally defined as someone who provides advice about securities for compensation and is in the business of doing so. Unlike a broker-dealer, an IA's primary role is giving advice rather than executing transactions or holding client funds. Registered representatives work for broker-dealers, while associated persons is a broader term that can include anyone affiliated with a FINRA member firm. Remember that the key differentiator for an investment advisor is providing advice for a fee. Question 3. Under FINRA rules, a registered representative is generally prohibited from borrowing money from a customer unless which of the following conditions is met? A. The loan amount is less than $10,000. B. The customer is a bank or immediate family member. C. The representative notifies their supervisor after the loan is approved. D. The customer agrees to the loan in writing. Answer: B. The customer is a bank or immediate family member. FINRA rules prohibit registered representatives from borrowing money from or lending money to customers unless specific conditions are met, primarily to prevent conflicts of interest and exploitation. Exceptions generally apply if the customer is an immediate family member or an institution that provides financial services, such as a bank. This rule is designed to protect both the customer and the integrity of the broker-client relationship. Always remember that strict ethical guidelines govern financial interactions between registered persons and their clients. Question 4. All of the following are typically characteristics of common stock except: A. Voting rights. B. Potential for capital appreciation. C. Fixed dividend payments. D. Preemptive rights. Answer: C. Fixed dividend payments. Common stock represents ownership in a corporation and typically comes with voting rights, giving shareholders a say in company management, and the potential for capital appreciation if the stock price rises. Shareholders may also have preemptive rights, allowing them to maintain their proportionate ownership if new shares are issued. However, common stock dividends are not fixed, they are declared by the board of directors and can vary or be eliminated based on the company's financial performance. Preferred stock, on the other hand, usually has fixed dividend payments. Question 5. Which of the following investments would be most suitable for an investor seeking a steady stream of income with a relatively low risk of principal loss? A. Common stock. B. Growth mutual fund. C. Treasury bonds. D. Options contracts. Answer: C. Treasury bonds. Treasury bonds are debt securities issued by the U.S. government, widely considered to have the lowest credit risk among all investments in the U.S. financial market. They pay fixed interest payments semi-annually and return the principal at maturity, making them suitable for investors seeking a steady income stream and minimal principal loss risk. Common stocks and growth funds carry more market risk and don't guarantee income, while options contracts are speculative and carry significant risk. For predictable income and safety, government bonds are often a primary choice. Question 6. A registered representative receives an order from a customer to sell 100 shares of XYZ stock at the market. This order type indicates the customer wants the trade executed. A. At a specific price or better. B. At the best available price immediately. C. Only if the price reaches a certain level. D. At the opening price of the next trading day. Answer: B. At the best available price immediately. A market order is an instruction to buy or sell a security immediately at the best available price. This type of order prioritizes immediate execution over price certainty. When a customer places a market order, they are telling the broker to get the trade done now, no matter what the current price is. Other order types, like limit orders, specify a price, but a market order seeks speed of execution. Question 7. The Securities and Exchange Commission, SEC, is responsible for which of the following? A. Setting interest rates. B. Regulating the U.S. securities markets and protecting investors. C. Insuring bank deposits. D. Printing currency. Answer: B. Regulating the U.S. securities markets and protecting investors. The Securities and Exchange Commission, SEC, is the primary federal regulatory agency responsible for overseeing the securities industry in the United States. Its core mission includes protecting investors, maintaining fair, orderly, and efficient markets, and facilitating capital formation. The SEC enforces federal securities laws, regulates exchanges, broker-dealers, investment advisors, and mutual funds, and requires public companies to disclose financial information. Always remember the SEC's foundational role in safeguarding market integrity and investor confidence. Question 8. All of the following are typically found on a new account form for an individual customer except: A. Customer's investment objectives. B. Customer's social security number. C. Customer's educational background. D. Customer's financial status. Answer: C. Customer's educational background. When opening a new account, broker-dealers are required to collect essential information to comply with regulations and ensure suitability, including the customer's investment objectives, financial status, income, net worth, and social security number for tax reporting. However, a customer's educational background is not typically required on a new account form as it is not directly relevant to suitability or regulatory compliance for opening a standard brokerage account. Firms focus on financial and risk tolerance information. Question 9. An investment company that issues a fixed number of shares that trade on an exchange and whose price is determined by supply and demand is known as A. Mutual fund. B. Unit investment trust. C. Closed-end fund. D. Exchange-traded fund, ETF. Answer: C. Closed-end fund. A closed-end fund is an investment company that issues a fixed number of shares through an initial public offering, IPO, and then those shares trade on an exchange like stocks. The price of closed-end fund shares is determined by market supply and demand, meaning they can trade at a premium or discount to their net asset value, NAV. In contrast, mutual funds, open-end funds, continuously issue and redeem shares, and their price is always based on their NAV. Remember that closed-end signifies a fixed number of shares, similar to a traditional stock issuance. Question 10. Which of the following actions by a registered representative would be considered a violation of FINRA rules regarding private securities transactions? Selling away. A. Selling a customer a mutual fund offered by their broker-dealer. B. Participating in a private securities transaction without prior written notice to their firm. C. Recommending an investment to a customer that is not suitable for them. D. Receiving a gift from a customer valued at less than $100. Answer: B. Participating in a private securities transaction without prior written notice to their firm. Private securities transactions, commonly known as selling away, occur when a registered representative executes securities transactions outside the scope of their employment with their firm. FINRA rules strictly require that a registered representative provide prior written notice to their firm before engaging in any private securities transaction. If the representative receives compensation, the firm must also approve the transaction in writing and supervise it. This rule helps prevent undisclosed conflicts of interest and ensures proper firm oversight of all securities activities. Question 11. What is the primary purpose of a cooling-off period in the new issue registration process? A. To allow investors to subscribe to shares. B. To allow the SEC to review the registration statement for deficiencies. C. To permit the underwriters to stabilize the stock price. D. To enable the issuer to make final marketing preparations. Answer: B. To allow the SEC to review the registration statement for deficiencies. The cooling-off period is a mandatory 20-day minimum waiting period after an issuer files a registration statement with the SEC for a new issue. During this time, the SEC reviews the filing to ensure it is complete and contains no misleading information. No sales or solicitations for sales can occur during this period, but indications of interest can be gathered. This period is crucial for investor protection, allowing for regulatory scrutiny before the offering becomes effective. Question 12. A customer wants to buy shares of a stock but only if the price falls to a specific level or lower. Which type of order should they place? A. Market order. B. Limit order. C. Stop order. D. Stop limit order. Answer: B. Limit order. A limit order specifies a maximum price an investor is willing to pay when buying or a minimum price they are willing to accept when selling. For a buy limit order, the order will only be executed at the specified price or lower. This gives the investor control over the price, but there's no guarantee the order will be executed if the market price doesn't reach the specified limit. Think of a limit order as putting a limit on the price you're willing to transact at. Question 13. Which of the following statements regarding municipal bonds is true? A. Interest earned on municipal bonds is always federally taxable. B. Municipal bonds are issued by corporations to raise capital. C. Interest earned on municipal bonds may be exempt from federal income tax. D. Municipal bonds are generally less liquid than corporate bonds. Answer: C. Interest earned on municipal bonds may be exempt from federal income tax. Municipal bonds are debt securities issued by state and local governments or their agencies to finance public projects like schools, hospitals, or roads. A key feature of these bonds is that the interest earned by investors is often exempt from federal income tax, and sometimes from state and local taxes if the investor lives in the issuing state. This tax-exempt status makes them attractive to investors in higher tax brackets. Unlike corporate bonds, which are issued by companies, municipal bonds are specifically government-issued. Question 14. An associated person of a FINRA member firm must complete the regulatory element of continuing education how often? A. Annually. B. Every 2 years. C. Every 3 years. D. Every 4 years. Answer: B. Every 2 years. FINRA's Continuing Education (CE) requirements mandate that all registered persons complete the regulatory element on an ongoing basis. This element must be completed within 120 days of the second anniversary of their initial registration and every 3 years thereafter for as long as they remain registered. Therefore, the frequency is every 2 years for the initial completion and then every 3 years subsequent to that, which effectively means every 2 years overall if you count the initial 2-year window. This ensures registered persons stay current with industry rules and regulations. Question 15. The term penny stock generally refers to A. Highly liquid stocks trading on major exchanges. B. Stocks issued by financially strong, well-established companies. C. Low-priced, speculative stocks trading in the over-the-counter, OTC, market. D. Shares of closed-end funds with a low net asset value, NAV. Answer: C. Low-priced, speculative stocks trading in the over-the-counter, OTC, market. Penny stocks are typically very low-priced, speculative securities that trade over-the-counter, OTC, rather than on major exchanges like the NYSE or Nasdaq. They are generally issued by smaller companies with limited operating history and often have little public information available. Due to their low price and limited liquidity, penny stocks are considered highly volatile and risky investments. Remember that penny refers to their low price, not necessarily a penny itself, and they carry significant risk. Question 16. The Uniform Securities Act, USA, is the basis for A. Federal securities laws. B. State securities laws, blue sky laws. C. FINRA's rules and regulations. D. International securities agreements. Answer: B. State securities laws, blue sky laws. The Uniform Securities Act, USA, is a model law that states use as a basis for their own securities laws, often referred to as blue sky laws. While federal laws like the Securities Act of 1933 and the Securities Exchange Act of 1934 govern the national markets, the USA provides a framework for state regulation of securities offerings, broker-dealers, investment advisors, and agents within their borders. Think of the USA as the blueprint for state-level securities regulation. Question 17. Which of the following is considered a prohibited activity for a registered representative under FINRA rules? A. Sharing in profits and losses in a customer account without written authorization from the customer and the firm. B. Accepting unsolicited orders from customers. C. Placing trades on behalf of a customer with their verbal consent. D. Opening an account for a new customer after verifying their identity. Answer: A. Sharing in profits and losses in a customer account without written authorization from the customer and the firm. Sharing in customer accounts is generally prohibited for registered representatives unless specific conditions are met. These conditions typically require written authorization from both the customer and the broker-dealer, and the sharing must be proportionate to the representative's financial contribution to the account. This rule is designed to prevent conflicts of interest and ensure fair treatment of customers. Always remember that any unusual arrangement involving a customer's account must have explicit firm and customer approval to avoid ethical violations. Question 18. A customer holds a security that gives them the right to purchase 100 shares of XYZ stock at a predetermined price of $50 per share at any time before the expiration date. This describes which type of security? A. A bond. B. A preferred stock. C. A call option. D. A put option. Answer: C. A call option. This scenario describes a call option, which is a contract that gives the holder the right, but not the obligation, to buy a specified number of shares, typically 100, of an underlying asset at a fixed price, the strike price, on or before a certain expiration date. A put option, conversely, gives the right to sell. Bonds are debt instruments, and preferred stock represents ownership with fixed dividends. Remember that a call means the right to call away or buy the shares. Question 19. All of the following are typically included in the definition of an issuer under the Securities Act of 1933 except A. A corporation offering its own shares to the public. B. A government entity issuing municipal bonds. C. An individual selling shares they purchased from a previous owner in the secondary market. D. A trust offering beneficial interests in a limited partnership. Answer: C. An individual selling shares they purchased from a previous owner in the secondary market. Under the Securities Act of 1933, an issuer is generally defined as every person who issues or proposes to issue any security. This includes corporations issuing new stock, government entities issuing bonds, and even trusts or partnerships issuing beneficial interests. However, an individual selling shares they already own in the secondary market is typically considered a non-issuer transaction, as they are not originating new securities into the market. The Act primarily focuses on the initial distribution of securities. Question 20. The maximum fine for insider trading is based on A fixed amount per violation. B. 3 times the profit gained or loss avoided. C. The value of the securities traded. D. Twice the amount of the commission earned. Answer: B. 3 times the profit gained or loss avoided. Insider trading involves using material, non-public information to profit from securities transactions, which is a serious felony. The Insider Trading and Securities Fraud Enforcement Act of 1988, ITSFEA, allows for civil penalties of up to 3 times the profit gained or loss avoided, treble damages, by the violator. In addition to civil penalties, criminal penalties can include fines up to $5 million and 20 years in prison for individuals. Remember that insider trading penalties are severe and directly tied to the ill-gotten gains. Question 21. Which type of investment company offers a professionally managed portfolio of securities, but does not issue a fixed number of shares and continuously offers shares to the public at the net asset value, NAV? A. Closed-end fund. B. Exchange-traded fund, ETF. C. Unit investment trust, UIT. D. Mutual fund, open-end fund. Answer: D. Mutual fund, open-end fund. A mutual fund, also known as an open-end fund, continuously issues new shares to investors and redeems existing shares on demand. Unlike closed-end funds or ETFs, mutual fund shares are purchased directly from the fund or its distributor and are priced at the net asset value, NAV, calculated at the end of each trading day. This open-ended structure means the number of shares outstanding fluctuates as investors buy and sell. Think of it as a pool of money that constantly adjusts to investor demand. Question 22. A bond's yield to maturity, YTM, takes into account all of the following except A. The bond's coupon rate. B. The bond's current market price. C. The bond's par value. D. The bond's rating from a credit agency. Answer: D. The bond's rating from a credit agency. Yield to maturity, YTM, is the total return an investor can expect if they hold a bond until it matures, taking into account the coupon rate, the bond's current market price, and its par value, face value. YTM effectively calculates the annualized return considering both interest payments and any capital gain or loss if the bond is bought at a discount or premium. A bond's rating from a credit agency, while important for assessing credit risk, is a qualitative measure of creditworthiness and is not a direct input into the quantitative calculation of YTM. Question 23. The Uniform Practice Code, UPC, under FINRA rules primarily covers which of the following? A. Rules for underwriting new issues. B. Ethical conduct and suitability requirements for registered representatives. C. Trade practices, such as settlement, good delivery, and confirmations. D. Rules for advertising and communications with the public. Answer: C. Trade practices, such as settlement, good delivery, and confirmations. The Uniform Practice Code, UPC, establishes uniform trade practices, definitions, and fair dealing among FINRA member firms. It covers operational aspects of securities transactions, including procedures for trade settlement, good delivery of securities, confirmation requirements, and computations of accrued interest. The UPC is designed to ensure consistency and efficiency in the processing and clearing of securities transactions between firms. Think of it as the rulebook for how member firms conduct the back-office aspects of trading with each other. Question 24. Which of the following statements about electronic communication networks, ECNs, is true? A. ECNs are primarily used for trading less liquid, over-the-counter securities. B. ECNs are fully automated electronic trading systems that match buy and sell orders. C. ECNs always guarantee the best possible price for a trade. D. ECNs require human intervention for all order matching. Answer: B. ECNs are fully automated electronic trading systems that match buy and sell orders. Electronic communication networks, ECNs, are computerized systems that automatically match buy and sell orders for securities in the marketplace. They operate 24 hours a day and allow institutional investors and broker-dealers to execute trades anonymously and directly without the use of a traditional broker. ECNs contribute to market liquidity and can offer tighter spreads, but they do not always guarantee the absolute best price, nor do they require human intervention for order matching. They are a core component of modern automated trading. Question 25. An investor who needs immediate access to funds and cannot tolerate market fluctuations would likely find which of the following investments most suitable? A. A 10-year corporate bond. B. A money market fund. C. A small-cap growth stock. D. A diversified equity mutual fund. Answer: B. A money market fund. A money market fund is a type of mutual fund that invests in highly liquid, short-term debt instruments, such as treasury bills, commercial paper, and certificates of deposit. These funds aim to maintain a stable net asset value, typically $1 per share, making them suitable for investors prioritizing liquidity and capital preservation over high returns. While not guaranteed, they are considered very low risk compared to stocks or long-term bonds, which are subject to greater market fluctuations. For safety and accessibility, money market funds are a top choice.